What if I told you that the biggest buying opportunities in the market almost never look attractive when they appear? Think back to almost every major market bottom in history. During those moments, financial news was overwhelmingly negative. Analysts were cutting their forecasts. Retail investors were selling in panic. Social media was filled with predictions that prices would fall even further. And yet, those were often the exact moments when professional money quietly began accumulating positions. The question is, how can two groups of people look at the exact same chart and come to completely different conclusions? The answer isn't found in price alone. It's hidden in volume. Price shows you where the market moved. Volume reveals who was responsible for that move. Professional traders don't simply watch candles. They study the relationship between price and participation. Because every market bottom leaves behind evidence. Not obvious evidence, but measurable evidence. In today's video, we're going to break down the mechanics behind market bottoms from a professional perspective. You'll learn why selling eventually runs out of fuel, how volume reveals institutional accumulation, why effort versus result is one of the most powerful concepts in technical analysis, and how to recognize patterns like stopping volume, selling exhaustion, buying climax, and volume divergence before they become obvious to everyone else. This isn't about predicting bottoms. It's about learning how professionals recognize when probabilities begin shifting in their favor. Let's begin. Chapter 1. Why every market bottom begins with fear. Before we discuss volume, we first need to understand what a market bottom actually is. Most beginners think a market bottom is simply the lowest price on the chart. Professionals don't. A market bottom is not a price, it's a process. Markets don't suddenly reverse because they decide to. They reverse because the balance between buyers and sellers changes. Every downtrend is driven by one simple force: more aggressive sellers than buyers. As long as sellers remain in control, prices continue falling. But eventually, something changes. Not because good news suddenly appears, but because the supply of shares being sold begins to shrink. Imagine a crowded theater where everyone is rushing toward the exit. At first, people push aggressively. Movement is chaotic. The crowd moves quickly. But after most people have already left, fewer people remain. Even though the exit is still open, the flow naturally slows down. Markets behave in a surprisingly similar way. During prolonged declines, fear pushes investors to sell. Weak hands panic. Short-term traders exit positions. Margin calls force liquidation. Stop-loss orders trigger automatically. Selling becomes emotional rather than rational. Volume often expands dramatically because everyone wants out at the same time. Eventually, most of the people willing to sell have already sold. This is one of the first hidden ingredients behind every market bottom. Not increased buying, but exhausted selling. Professionals understand something that many retail traders overlook. A market doesn't need aggressive buyers to stop falling. It simply needs fewer aggressive sellers. That's an important distinction, because when selling pressure begins fading, even modest buying demand can stabilize prices. This is where volume starts telling a completely different story than price. On the chart, price may still appear weak. News headlines may still be negative. Sentiment may still be bearish. But underneath the surface, the auction process is changing. Institutions pay close attention to these moments. Why? Because institutions cannot buy millions of shares in one transaction. They need liquidity. And panic selling provides exactly that liquidity. When retail traders are desperate to sell, professionals often become willing buyers, not because they know the exact bottom, but because risk begins decreasing while opportunity begins increasing. This transition rarely happens in a single day. It's usually a gradual shift. and volume is often the first clue that this shift has started. Chapter 2. Why price alone never tells the complete story. If price were all you needed to understand the market, every trader looking at the same chart would reach the same conclusion. But that never happens. Some traders see a buying opportunity. Others see the beginning of another crash. Why? Because price only tells you what happened. It doesn't tell you how much effort the market used to produce that move. This is where volume becomes essential. Think of price as the final score of a football game. The score tells you who won, but it doesn't explain how the game unfolded. Did one team dominate from start to finish? Did they win after multiple turnovers? Was it a defensive battle, or was it a last-second comeback? The final score hides the entire story. Price works the same way. A 3% decline may look identical on two different trading days, but the volume behind those declines can be completely different. One decline may happen with average participation. Another may occur with record-breaking volume. To the untrained eye, both look the same. To a professional, they're completely different events. Price is the result. Volume is the evidence. Imagine a company announces disappointing earnings. The stock drops 5%. Many traders immediately conclude that the trend has turned bearish. But professionals ask a different question. How many people participated in that move? If volume is unusually low, the decline may simply reflect a temporary lack of buyers. If volume is exceptionally high, it suggests strong conviction from market participants. The size of the move matters, but the commitment behind the move matters even more. That's why experienced traders never analyze price without volume. Every candle tells two stories. The visible story is price. The hidden story is participation. Volume reveals whether the market truly believes the move. Chapter 3. The effort versus result. Principle. One of the most powerful concepts in professional market analysis is called effort versus result. The idea is surprisingly simple. Every price movement requires effort. In the financial markets, volume represents effort. Price movement represents the result. When effort and result agree, the trend is healthy. When they disagree, something important may be changing beneath the surface. Let's explore both situations. Scenario 1. High effort, strong result. Suppose a stock has been consolidating for several weeks. Then, one morning, buyers step in aggressively. Volume jumps to 3 times its daily average. The stock breaks above resistance and closes near the day's high. High effort, strong result. This tells us buyers were willing to commit significant capital and they achieved meaningful price progress. Effort and result are aligned. This is typically a sign of strength. Scenario 2. High effort, weak result. Now imagine something very different. The stock opens lower. Volume explodes to the highest level in months. Thousands of traders panic and sell. Yet by the end of the day, the stock closes only slightly lower, or even recovers most of its losses. Think about what just happened. The market absorbed enormous selling pressure. Despite massive selling effort, price barely declined. That's abnormal. If sellers were truly in complete control, price should have collapsed. Instead, someone absorbed all that supply. Who has the financial resources to absorb millions of shares? Not individual investors, institutions. This is why professionals pay close attention to high-volume days with surprisingly small price movement. It often suggests that strong hands are quietly buying from weak hands. The public sees fear. Professionals see absorption. A real-world mental model. Imagine trying to push a heavy truck. At first, the truck rolls easily. Every bit of effort moves it forward. But suddenly, you push harder and harder. Yet the truck barely moves. Has your effort increased? Yes. Has the result increased? No. Something is resisting your force. Markets behave the same way. If sellers push with maximum effort and price barely falls, it often means strong buying demand is absorbing that selling pressure. That resistance is often invisible unless you're studying volume. How this helps identify market bottoms. Near major bottoms, selling pressure often reaches its highest intensity. News is negative. Sentiment is pessimistic. Volume surges. Everyone expects another large decline. But instead, price stops making meaningful progress to the downside. This is the first warning sign that the balance between buyers and sellers is changing. Notice what we're not saying. We're not saying the bottom is confirmed. We're saying the probability of continued aggressive selling is beginning to decrease. That's a very different conclusion. Professional traders don't predict, they observe. And one of the first observations they make is whether effort still produces the expected result. When it doesn't, the market may be preparing for a transition. The key lesson: whenever you see unusually high volume, ask yourself one simple question. Did price move as much as I would have expected? If the answer is yes, effort and result are aligned. If the answer is no, something unusual is happening beneath the surface. And unusual behavior is often where the biggest opportunities begin. Chapter 4. Stopping volume, the first sign that selling pressure is being absorbed. Now that we understand the relationship between price and volume, let's move to one of the most important concepts in identifying potential market bottoms. Stopping volume. This is one of the earliest clues that professional traders watch for during a prolonged downtrend. But before we define it, let's clear up a common misconception. High volume does not automatically mean a stock is bullish. Likewise, low volume does not automatically mean weakness. Volume only becomes meaningful when it's interpreted in the context of price. That's why stopping volume isn't just about seeing a large volume bar. It's about understanding what happened after that volume appeared. What is stopping volume? Stopping volume occurs when a market has been declining for an extended period, and suddenly one or more trading sessions experience exceptionally high volume, but price makes little additional progress to the downside. Think carefully about what this means. For weeks, sellers have controlled the market. Every wave of selling pushed prices lower. Then one day, selling activity reaches an extreme. Millions of shares change hands. Fear is everywhere. Yet the market doesn't collapse. Instead, price stabilizes. Sometimes it even closes well above the day's low. That change in behavior is significant, because the selling effort increased dramatically, but the downward result became smaller. That is the essence of stopping volume. Why does this happen? Imagine a warehouse filled with boxes. For weeks, workers have been removing boxes from the warehouse. Eventually, only a few boxes remain. Even if the workers continue showing up with the same intensity, there's simply less inventory left to remove. The process naturally slows down. Markets work in a similar way. After a prolonged decline, many emotional sellers have already exited. Weak hands are gone. Late sellers panic. News becomes extremely negative. Then, institutions quietly begin absorbing the remaining supply. Retail investors see disaster. Professional investors see liquidity. And liquidity is exactly what institutions need to build large positions. Case Study 1. A panic sell-off. Imagine a technology stock trading at $80. Over the next 6 weeks, it falls steadily to $52. Every rally fails. Every headline becomes more negative. Investors begin saying, "This stock is finished." Then one morning, another wave of selling hits the market. The stock opens at $50. Within minutes, it falls to $47. Volume explodes to nearly 4 times its daily average. everything looks extremely bearish. But something unexpected happens. Large buyers begin absorbing shares. The selling pressure slows. By the close, the stock finishes at $51.80. Notice what changed. The biggest volume day of the decline produced one of the smallest net losses. That's not normal behavior. It's evidence that demand may finally be matching supply. Not proof of a bottom, but an important clue. Chapter 5. Selling Exhaustion. Let's take the idea one step further. Stopping volume tells us that selling is being absorbed. Selling exhaustion tells us that selling pressure itself may be disappearing. These concepts are related, but they're not identical. Think of a marathon runner. At the beginning of the race, they're full of energy. Every stride is powerful. As the race continues, fatigue sets in. The runner still moves forward, but with much less force. Eventually, they're exhausted. The same thing happens during long market declines. Early sellers are confident. Later sellers become emotional. Eventually, there are very few sellers left. At that point, even modest buying demand can begin pushing prices higher. Not because buyers suddenly became aggressive, but because there simply aren't enough sellers left to resist them. How volume reveals exhaustion. Professionals look for three conditions occurring together: a prolonged downtrend, extremely high volume after panic selling, very limited downside progress despite heavy selling. When these conditions appear together, the market may be approaching a point where supply is drying up. Again, this doesn't guarantee an immediate reversal. Markets often spend days or weeks building a base, but this is frequently where that process begins. Chapter 6. Institutional Accumulation. One of the biggest mistakes retail traders make is assuming institutions buy exactly where everyone else buys. They don't. Large funds can't simply press a button and buy millions of shares at once. Their orders are too large. Doing so would push prices sharply higher. Instead, they accumulate gradually. They buy when liquidity is abundant. And where is liquidity greatest? During panic, because that's when frightened investors are willing to sell almost any amount. This is why some of the highest volume days occur near major market bottoms. Those transactions require both buyers and sellers. Without institutional demand, panic selling would push prices much lower. The market stabilizes because someone with deep pockets is quietly absorbing supply. Retail traders focus on headlines. Professionals focus on order flow. Key takeaway. Whenever you see extreme fear combined with unusually high volume and surprisingly limited downside movement, ask yourself, who is buying all these shares? That simple question can completely change the way you interpret market behavior, because every share that's sold must also be bought. If millions of shares are changing hands without a dramatic collapse in price, someone with significant capital is likely participating. And that's exactly the type of activity professionals pay close attention to. Chapter 7. Buying Climax versus selling Climax. By now, we've established that volume is not inherently bullish or bearish. Its meaning depends entirely on context. This brings us to two of the most misunderstood concepts in volume analysis: buying Climax and selling Climax. Although both involve exceptionally high volume, they occur at opposite ends of a market cycle. Selling Climax. A selling climax typically occurs after a prolonged downtrend. Fear reaches its highest level. Retail investors begin selling simply because everyone else is selling. News headlines become overwhelmingly negative. Volume explodes as panic spreads across the market. But despite this intense selling pressure, price often fails to make a significant new low. Instead, buyers begin absorbing shares. This doesn't guarantee an immediate rally. However, It often signals that the market is entering an accumulation phase. In other words, the emotional selling that fueled the downtrend may finally be running out of energy. Buying Climax now. Let's look at the opposite situation. Imagine a stock that has been rallying for months. Every financial news outlet is optimistic. Analysts continue raising their price targets. Social media is filled with success stories. Retail traders experience FOMO, the fear of missing out. Everyone wants to buy. Volume reaches an extreme. Price surges sharply. Then, unexpectedly, the stock struggles to move higher despite all the enthusiasm. Why? Because professional investors are no longer buying. They're selling into the excitement. Retail traders see a breakout. Institutions see an opportunity to distribute shares. This is what professionals refer to as a buying climax. It's often a sign that demand is becoming exhausted. Chapter 8. Volume Divergence. One of the most valuable signals in professional chart analysis is volume divergence. Divergence simply means that price and volume are no longer telling the same story. When these two begin to disagree, it often signals that the current trend is losing strength. Let's look at two examples. Bullish volume divergence. A stock continues making slightly lower lows. At first glance, the chart still appears bearish, but something unusual happens. Each new low is accompanied by less selling volume than the previous one. Price continues falling, yet participation keeps declining. This suggests that fewer market participants are willing to sell at lower prices. The trend still exists, but its momentum is fading. Professional traders recognize this as a potential early warning that the downtrend is weakening. Bearish volume divergence. Now consider an uptrend. The stock continues making higher highs. Everything appears healthy. But volume begins shrinking with each rally. Price is moving higher. Participation is moving lower. Fewer buyers are supporting the advance. This doesn't mean the market will reverse immediately. However, it tells us the trend is becoming increasingly fragile. Strong trends are usually supported by healthy participation. Weak participation often signals weakening conviction. Real-world case study. Imagine a stock that has declined from $150 to $90 over several months. During the final stage of the decline, trading volume reaches the highest level in 6 months. The stock briefly falls to $87. Buyers quickly step in. The stock closes at $91.50. Over the following 2 weeks, price stops making meaningful new lows. Selling volume gradually decreases. A few weeks later, price breaks above a key resistance level on strong volume. Notice the sequence. First came panic, then absorption, then reduced selling pressure. Finally, renewed buying. Professional traders don't focus on one isolated signal. They look for multiple pieces of evidence working together. The professional market bottom checklist. Instead of asking, "Is this the exact bottom?" professionals ask, "Is the evidence becoming increasingly bullish?" Here's a simple checklist. A prolonged downtrend has already occurred. Selling volume expands dramatically. Price stops falling despite heavy selling. Large lower wicks begin appearing on candles. Selling volume gradually decreases over time. Price begins forming higher lows. Breakouts occur with expanding volume. The more boxes that are checked, the stronger the probability that market conditions are improving. Notice the word probability, not certainty. Professional trading is based on probabilities, not predictions. Common mistakes. Retail traders make. Let's finish by discussing the mistakes that often lead traders to misread market bottoms. Mistake number 1. Assuming every high-volume day is bullish. High volume without context means very little. Always analyze how price reacted. Mistake number 2. Trying to catch the exact bottom. Professionals don't need the lowest price. They need evidence that the balance between supply and demand is changing. Mistake number 3. Ignoring the broader trend. A single bullish volume signal means much more after a prolonged decline than it does in the middle of a random trading range. Mistake number 4. Making decisions based only on news. News often reflects what has already happened. Volume frequently reveals what institutions are doing before the headlines change. Final thoughts. Market bottoms are rarely identified by one candle, one indicator, or one headline. They're identified by a gradual shift in market behavior. Volume helps us observe that shift. When selling pressure no longer produces meaningful downside results, when institutions begin absorbing supply, when participation starts confirming improving price action, the market begins sending signals that conditions are changing. No signal is perfect. No method guarantees success. But by learning to analyze the relationship between price and volume, you move beyond simply reacting to charts. You begin reading the mechanics that drive the market itself, and that is one of the most valuable skills any serious trader can develop.